I'll just stand back. That's the one I need. Hello. Right, we're waiting on one person, actually a couple of people, but we're trying to, so we won't delay any further. We will start. Thank you all so much for coming. This is a few more people than last year. Seriously, thank you very, very much for taking time out of your day to come to this event. It takes a lot of work to actually get it going, but we appreciate everyone turning up, and we're going to do our absolute best for the next hour and a half or so to give you as much insight into what goes on in the world of investment management, in the world of investment funds, to bring to life that squiggly line you see on the piece of paper every time we have a review. Okay? A little bit of housekeeping. Toilets, if you're not familiar with the White Hart, there's some toilets just up the stairs. If you can't do stairs, there's some toilets through the other side of the building that are on the flat all the way. There's no planned fire alarms. If you need to escape, there's a big old fire door there, or there, or there. Mobile phones, if you haven't already, please put it on silent or on do not disturb or whatever, just so it doesn't disrupt the presentation. Questions, if you've got a question during the presentations, the first two, save it until the end. Kath. I haven't, but I can talk louder than this. I'll try not to spit in your Zoe though, right. Can you hear at the back okay, or are you struggling as well? You can hear okay, okay. Right, so James Clemster, you've got a louder voice than me. You've got to remember this, okay? Questions. Save them until the end of the first and second presentations. But if you've got a wider question for the two fund managers, we've got a Q&A session as a third deal of the day. And that's where we'll open the floor up and ask as many questions as you like. This is the agenda. First of all, we'll have me talking rubbish for 5 minutes. Then we'll have Ben from Orbis. Ben, give us a wave. Then we'll have James Clemster from Liontrust. James, give us a wave. And then we'll have a panel of also Eddie Barstow from Columbia Threadneedle, who's a special guest today that we didn't have planned. So yeah, whoa, there you go, thanks. Then we'll have a Q&A and we'll be finished for about 4 o'clock. If you guys are all flagging, we'll call it a day earlier. If you're having a really, really great time, we'll carry on a bit longer, it's flexible. This is all of the personnel that work at ARK Financial Planning. You probably recognise all of us, but we're going to do the waves again. Hi, I'm Brad. Phil Stevenson. It's a good wave. Rebecca. Zoe, stand up. Come on, give us all the wave. This is Zoe. Anna. And Cara, stand up. Effectively, me and Phil do the actual face-to-face financial advice, and then the girls in the background do all of the legwork. You probably see that when you email and speak to us, but these people at the bottom are actually what keep ARK ticking. So thank you very much to you guys. The special guests today, James Clemster, Ben, Eddie and Graham, I've already introduced. And just to position why we've got the fund managers here, so Columbia Threadneedle, Liontrust and Orbis, and not the platforms, who you may be familiar with, Prudential, Quilter, Parmenion. Yes, they are who your pension or ISA or investment is with, okay? So when you log into the Fundment app or the Quilter app, you'll see that logo there. All they're doing is giving you access to the investment funds and actually the squiggly line that we're going to be talking about today if my presentation catches up. Yeah. So the investment funds, Columbia Threadneedle, Orbis, Liontrust. Some of you may also use Prudential, who aren't here today. Their compliance department said no, which was nice of them. There we go. So if we had the platforms here today, i.e. Quilter, Fundment, Elevate, whoever you're with, it'd be really boring. It would be about technical data and about how they could apply a bit more tax relief a bit quicker or make a payment 5 days quicker, and you'd be like, that is boring. The exciting stuff is what the fund manager is going to tell us, which is the little changes that they make on a day-to-day basis to provide you with that little bit of extra growth that you would have otherwise not got, okay? Just to put that into perspective, ARK's global headquarters, the 6 of us, based in Oldham in Manchester, as you know. The platforms, they're pretty big, maybe 100 staff. The fund houses are massive. Columbia Threadneedle, 8th biggest asset manager in the world. Go on. Okay, all right, sorry. 30. There's thousands though, so 36 is still pretty good going. Thousands and thousands of staff. I think the stuff on the tables tells you the size of the companies. So these are big fish. Having the fund managers here today is a big deal. This is the kind of reach they've got, so they don't just work out of London. If you read the biographies of the presenters, these guys have worked all around the world. They regularly visit sites around the world to get an idea of what's going on, to put your money at best use as possible. Anybody recognize this guy? Shout it out. No, not quite. Anybody? Harry Enfield. Do you know reckon there's a character? It's Angry Frank. Do you remember the guy in the pub? Yeah. I tried to get AI to like move his mouth to go, "Oi, this is not financial advice," but I couldn't. So I just have to put a picture of him and try and get the reference going. I did ask AI to do it for me, and this is the response I get, was just a written version of it. But Phil Stevenson very kindly said he would reenact and read that out in the style of Angry Frank.
Oi, not financial advice.
Okay, any questions before we begin? I'm going to tell them. Rebecca's just reminded me to tell you, the bar will be open at 4 o'clock if you would like to stay for a drink at the end. James? No, you're not. Ben's going first. Thanks, James. Forget that slide. I'll put Ben's slide on. That's me. I'm sorry. Now, Ben's a Yorkshireman. I'm not going to hold that against him. But I did specifically tell him to send us slides in a 4x3 format. And because he's very kind, he sent them in a 16x9 format, which means I have to do this.
It's the future, I'm told, by my compliance department, like garlic bread. I didn't know we were doing Harry Enfield characters. I'd have made a joke along the lines of, hopefully, if we all do our jobs right as your asset managers, you'll be able to be the character that goes, and I'm considerably richer than Yao. Good afternoon, everyone. Yeah, my name's Ben Moxon from Orbis Investments. I have to say, kudos to ARK and the team that have put this on today, because I have been doing my job with Orbis for 8.5 years now, and this is the first time I've ever been asked to present at a direct client event to the end user yourselves. I didn't realize it was an option to get compliance to say no on my behalf, so here I am in front of you now. I'll bear that one in mind for next time. But no, genuinely, it's really good, because it means you're getting a pretty unique experience here, because nobody else is offering you this direct insight into what the fund managers are doing with your money and what we think of the world. So hopefully you'll get a good insight of that today. I'm very aware that quite a few of you will have some assets with Orbis for investments that I think Brad and the team started allocating to Orbis just under a year ago. So a lot of you will be invested with us, but I'm sure a lot of you don't know much about us. So I'm hoping to put that right today. And I've started specifically with this image for a reason, because if you ask 100 engineers how best to build a bridge, and 99 of them say one particular way, and just one of them has an alternate view, you're probably well advised to go with the 99. Because in engineering, there is a right answer, i.e. the bridge will stand, and there is a wrong answer. And the consensus view is the safest thing to do and the right thing to do. Investing is not necessarily like that. If 99% of investors tell you that a stock is a good bet, it might not be. For the reason that if the 99% of the population think that that is a good stock, that comes with its very high expectations, and those expectations are very often baked in to the price that you're paying in the first place. And one thing I can guarantee you about Orbis Investments is we do not follow the herd. We do things very, very differently. So I want to spend this time that we've got together today just to introduce you to Orbis, tell you a bit about who we are and how we think about the world, and also give you a few ideas of the kind of stocks that we find quite exciting in the market today. This is us in a nutshell, if you like. We've been around for approaching 40 years now. We've got £47.5 billion assets under management. And that 43 investment analysts that we have here is a very important number. That's a lot of very, very, and I mean very, very intelligent people running around looking at individual stocks for us to try and tell us which ones we think might be a good place to invest. That's an awful lot of people doing that job for the size of company that we are. But we are highly active investors. That means we don't buy the market, we don't buy the indices. I know you've got a cheat sheet. If it says passive investing, that's not what we do. We are active. We go out there and we individually select stocks that we think the market has mispriced and misunderstood, and we'll be able to outperform the market over the long term. And so we describe our investment philosophy as fundamental, long-term, contrarian. And in a nutshell, fundamental just speaks to the company fundamentals and that deep research and homework we need to do on a stock to get comfortable with it before we even consider putting it into a portfolio. Long term, because we have to be patient. In the way we work things, we're looking at a 3 to 5 year time horizon. That's when we're looking to outperform over that time period. So we hope that you can be as patient as we are to come along that journey with us. And contrarian, which I think is a slightly odd word sometimes. I think in normal parlance, contrarian can be seen as, oh, he's a bit different, or he's just pig-headed, or different for the sake of being different. In terms of investment, it just means being brave and being willing to go against the crowd because you think you've got an edge and you understand more about something than the rest of the market does. So I've titled this slide £1 for 70 pence because what I'm trying to do is just kind of walk you through the life cycle of a stock with Orbis, because what we're trying to do is essentially buy £1 for 70 pence. And the way it works is we spend a long time using those analysts to try and understand what we call the intrinsic value of a stock. Essentially, if you were to look at that business as if you had all the money in the world and you wanted to buy the entire company, what would be a fair price for that company, having done all of your deep fundamental research? And what we're trying to do is we understand that the market doesn't necessarily have all of the information because you can't look at everything all the time, all at once. Markets are priced by human beings, and human beings have overreact to good news, they overreact to bad news, and this is where we can operate in the margins by doing that deeper fundamental research. And so we look to try and buy a stock when the market is significantly underpricing it. We might be able to pick it up, as I say, for maybe 70 pence a share when we think it should be worth about £1 a share. And crucially, not only do we think we can pick it up at that discount, but we think there'll be some sort of catalyst along the way which will mean the market catches up with our opinion and it becomes worth £1 at some point in a kind of a 3 to 5 year time horizon. And that's when we look to sell. So essentially, I'm a fund manager standing up in front of you and saying, we look to buy low and sell high. And who isn't trying to do that, right? But there is quite a lot of science behind it. In terms of what we have on offer, I think most of you in the room will be invested in at least one, if not two of these funds. Our global equity fund is our flagship fund. We've been running that fund since 1990, so it has a very, very long track record. It is 100% equities though, so it is relatively relatively risky in terms of its risk profile. So more people would be more likely to be in this global balance fund. That's a medium risk fund. It's got stocks, bonds, a mixture of other different things in it as well. That's the one that's getting most of the flows from the UK retail market. And that's, as I say, about a 5 out of 10 on the risk profile. That was launched in 2013, so it's got quite a long track record. And then this one is the Global Cautious Fund. It's essentially, I'm not supposed to say this, but it's essentially the baby brother of the Global Balance Fund. It's the same investment team. It's just dialed down in terms of risk. And there's a lot of overlap in terms of what is owned between the Cautious Fund and the Balance Fund, but it's just dialed down in terms of risk. But that's it. That's all we offer, 3 funds, because we believe in doing a small number of things and doing them well. A lot of asset managers, not in this room, but a lot of asset managers will have 35, 40, 50 funds, and they'll send someone like me just to go and talk about the one that's doing well at the moment. We think the best thing to do is concentrate on a small number of things and try and do them very, very well. Okay, I want to start by warming you up and asking you a question first. Now, it's not particularly fair because this is really a slide that we put together for the advisor audience, but I thought I'd take the temperature of the room anyway. And I'm going to give you multiple choices so you can, whichever one you think might be the case. So which of these headlines do you think is plausible to happen by the end of the year? If you think that gold will reach another record high at the end of the year, please put your hand up. If you think that oil might close the year above $150 a barrel, it's currently $100 a barrel. Emerging markets will outperform developed markets. That's probably a little bit more of a technical question. The US loses its safe haven appeal. And then finally, AI leads to global power shortages. Thank you very much for all your answers. I'm here to tell you, I don't know any more than you do. Right? Genuinely, this stuff is very, very difficult to call. And it reminds me of the quote by a US economist a few years ago, a guy called John Galbraith, who said there are 2 types of forecasters in the world. There are those that don't know, and those that don't know, they don't know. So forecasting is very, very difficult. But the good news is, it's okay, we don't need to. What we do is we stick to just 2 principles when we're looking for the stocks that we want. Firstly, we seek low expectations from the market. And secondly, we get actually diversified. So I'm going to explain what I mean by those 2 different rules. And the first one then, seeking low expectations. Because, as I said before with the bridge discussion, if there's a lot of hype around a particular stock, that means there is a lot of excitement, there's a lot of expectation. And actually, the more excitement and the more expectation, the more likely it is to fall short of those expectations. And just a small fallback in terms of quarterly report or some sort of earnings kind of release, if it's just not quite as good as we all thought it would be, it's a bubble, we need to jump out, and often you see the price comes down. But quite often the opposite can be very, very true. If nobody expects anything from a stock, it's just bumbling along, it's doing absolutely nothing, it's not going to be very exciting and very interesting, and then it has some news that just surprises the market on the upside just a little bit, you can see a massive increase in the price of that stock, because suddenly everyone goes, oh, I hadn't noticed that, that's interesting, maybe that could be better than we thought it could be. So seeking low expectations is the first rule. But the second rule is to get actually diversified. And it's the word actually that's doing a lot of work here. Now, Bradley told me not to get very technical in this presentation. So I might be in trouble here with Bradley. Hopefully he'll come along with me. Please stick with me. This is the most technical part of the presentation, but it's a really important point, and I wanted to make it. So we have the FTSE World Index. Just call that basically the 2,000 biggest stocks in the developed world. And I can rank those 2,000 companies, firstly by how expensive they are across the x-axis, and then by how economically sensitive they are across the y-axis. And that's going to give me 4 natural quadrants. I'm going to have the cheapest stocks are going to be on the left-hand side of the chart, and the really expensive stocks will be on the right-hand side of the chart. And then at the top are all going to be cyclical stocks. So these are stocks that are quite sensitive to economic change and the economic backdrop that we find ourselves in. And at the bottom are going to be your defensive stocks. So these are ones that tend to plod along. It doesn't really matter what's going on in the world economy. They'll just carry on doing what they do. Now, to try and bring you along on this journey with me, I thought I'd give you an example of the kind of stock that sits in each of those quadrants. And you can just make out, because of my amazing 16:9 slides, on the left-hand side there, we've got Apple, BMW, LVMH, any bougie people? That's Louis Vuitton, Moet Hennessy, handbags and champagne, and then BAT, British American Tobacco. Now, to try and coax you out of your shells, the first person to give me the correct answer will win one of these very coveted Orbis notebooks. And it is, I'll tell you, I'm not even joking, these have a street value of £35. They're so expensive now. I bought these pre-COVID. They were sent to me in a box pre-COVID, and I think they were worth about 12, 15 quid at the time. They're now so expensive, I'm not allowed to give them to Bradley and other advisors because the regulator thinks I might be trying to buy all of your business by giving him one of these amazing notebooks. Okay, so I'm going to start. We've got, bear in mind, you've got Apple, BMW, LVMH, BAT. I'm going to start in this top left-hand corner here. This is the expensive cyclical quadrant. So what we're looking for is an expensive stock. And I'll give you a clue. Its products are very expensive. Louis Vuitton, I heard. There you go. Louis Vuitton. There you go. Louis Vuitton. Because Louis Vuitton is not only expensive, but it's cyclical. So what do I mean by that? I mean, in an economic downturn, in a recession, I'm not going to go out and buy my wife a Louis Vuitton handbag. And we're not going to consume champagne. So when we're feeling a little bit hard up, that's when we're not going to be buying that kind of thing. So it's an expensive stock, very expensive, but it's quite cyclical because it's quite sensitive to the economic backdrop that we find ourselves in. Thank you very much. Right, I've got another one now for the complete opposite of that. We're now in the cheap defensive quadrant. So this is a very cheap stock. Very good. Well done. It's also defensive because we tend to consume BAT products regardless of what the economic backdrop is doing. In fact, research says people smoke more when there's an economic downturn because everyone's a little bit more stressed. So does that make a bit more sense? What I love about BAT is it has the self-awareness to be a tobacco company with a tagline that says a better tomorrow. You just can't make that up. Okay, top left now. I will give a book for this one. Top left, you see you're looking for a relatively cheap stock but quite cyclical. Is it BMW or Apple? BMW. There you go, you're sweeping up on this table, aren't you? It's BMW. So it's cheap. I won't get into the price earnings, but it is very cheap at the moment to buy BMW as a stock. But it is obviously cyclical because we don't go around buying brand new Beamers when there's an economic pullback. We kind of keep the one we've got. So that's why it's cheap cyclical. And then finally, in that bottom right-hand quadrant then, would be Apple. It is mega expensive. Sorry, I'm not giving a book away for that one. It is mega expensive, right? Really expensive stock. It's one of the biggest companies in the world. But the reason it's defensive is because people love their Apple products. Such is the kind of the brand awareness that people will continue to buy the new phone, the new iPad, whatever it would be. They will still go out and buy it, even in an economic downturn. So it's still quite defensive, even though it's so expensive. Are we there? Does that make sense? That's the kind of stock you're going to find in each of these four quadrants. So now I'm going to plot 2,000 dots on this chart to show you how lopsided the market is today. When it works. So that doesn't show how lopsided the market is. What that shows is probably what you'd expect when you're doing an exercise like this. If these are all relative to each other, you've got a nice even distribution of companies across the world. So what's the story? Well, that doesn't tell you where the money is. That tells you where those stocks sit on this chart. To understand where the money is today, we need to adjust the size of those dots for the size or the value of the company that it represents. And when you do that, that's when you get a completely different picture. All of the money in the world markets at the moment is sucked down into this bottom right-hand quadrant, this expensive defensive kind of quadrant. And that's unusual. 62% of that world index is held in that one quadrant today. So in a normal market, you might expect 25 in each. 62% is in that one quadrant at the moment. Everything is focused down there. And I can prove to you that that's not normal because I can go back 10 years to the same date in 2016 and show you that you get a nice distribution of the largest companies across those 4 different quadrants. I can go back a further 10 years to 2006 and you get the same picture. This is what a healthy market is supposed to look like. It's not supposed to look like what it is at the moment. In fact, the last time it looked anything like this was in December 1999. And I'm not being funny, but some of you look old enough to know what happened just after December 1999. We, of course, went into the dot-com bubble crash. So that's a little bit of a concern that this is where we are at the moment. But even back then, in December 1999, only 54% of the market in December 1999 was held in that one quadrant. Today, it's 64%. Okay, so it's really concentrated in that small quadrant. Does anybody know the kind of stocks you might be talking about down there? Correct, yeah. You might have heard this term, the Magnificent Seven. I think it's on your cheat sheet, but I'll explain what the Magnificent Seven is. It's the 7 largest companies in the world that have almost come from nowhere. They're just absolutely huge all of a sudden in the last kind of 5 or 6 years. So they're names that you're probably very familiar with. Alphabet is the holding company of Google. If you get as many parcels delivered to your wife as I get, you'll know all about Amazon. NVIDIA designed the chips that go into all of the AI kind of stuff at the moment. Meta is the holding company for Facebook, Tesla cars, and rocket ships and everything else that they do, Microsoft and Apple. Okay, so that's what the people mean when they talk about the Magnificent Seven. So they're huge, 7 huge stocks. And to show you just quite how big they are, if you put them all together, those 7 stocks, they make up nearly a quarter of the index. So 2,000 stocks and 7 of them account for a quarter of the value. That's off the scale, right? You can put that next to the 7 largest markets outside of the US. So every listed stock in Japan, UK, Canada, France, Switzerland, Germany, and Australia put together is not as big as those 7 stocks put together. That's how expensive they are at the moment. Now, they've done that offering just 13% of world profits. So they're not offering a lot for it when you consider that the mundane 7, those markets I've put there, they've done it for 30% of the profits. So you see what I mean about hype and about expectation. It's a lot of this is down to the AI kind of bubble that we're seeing at the moment, the AI excitement. It's going to change our world. Yes, it is going to change our world. But at what cost? So I've got a second question for you, and I promise you there is an answer to this question. In terms of the projected spend, just this calendar year, 2026, do you think the projected spend on AI is about commensurate to one of these kind of big events of the past? So the building of the Burj Khalifa, the largest building in the world, the Channel Tunnel, putting on the 2010 World Cup in South Africa, the Manhattan Project that obviously gave us the atomic bomb, and the International Space Station. Very perceptive, I'm impressed. I am impressed. So, Burj Khalifa, $2 billion. That seems like a good deal, right? I think there's property in London going for close to $2 billion these days. 12 billion for the Channel Tunnel. All of this is inflation adjusted, by the way. So 12 billion for the Channel Tunnel, 14 for the World Cup, 30 for the Manhattan Project, 150 for the International Space Station. You nearly got the right answer. It is all of them put together, but then multiply it by 3. in just this calendar year, 2026. Now, I know it's only a cheat sheet. I plan to say this, but Brad's already got there ahead of me. I am reminded that someone told me this a few years ago, and this is stuck in my head. The difference between 1 million and 1 billion, because we kind of bandy these words, these figures around. 1 million seconds ago was about 11 and a half days ago. It was about a million seconds ago that France were getting beaten by England in the third, fourth place playoff. To give you an idea, that was 1 million seconds ago. 1 billion seconds ago was 32 years ago. That was the mid-90s, 1 billion. That's the difference between 1 billion and 1 million. 650 billion seconds ago, that was 20,000 years ago. It was 1860 BC, no, 18,600 BC, apologies. It was the Stone Age, 650 billion seconds ago. Gives you an idea of the scale that's been put in to AI. Now, AI, I am sure, will change a lot about the world. But my point here is picking the winner out of the current crop is very, very difficult to do and very risky because of all of that expectation that's built in. And it reminds me of the dot-com bubble, because one of the biggest winners, probably the biggest winner of the internet, which changed the world, was probably Google. And Google didn't hit the market until 2004. So 4 years after the dot-com bubble crashed is when Google IPO'd, and they're probably the biggest winner of the internet. I'm not telling you all of these companies are going to crash and there's going to be a completely new one that comes in. I'm just showing you how difficult it is to predict this kind of stuff. So what I want to do for the rest of this presentation is move away from AI, because I can't pick a winner any better than you can. But it's a big wide world out there. Seek low expectations and get genuinely diversified. You want different things in your portfolio. They're going to act differently under different stimulus. So I'm going to take you on a little bit of a tour of the world and give you an idea of the kind of stocks that we think look quite attractive from this kind of bottom-up perspective in terms of how we see the world. And the first stop is Japan. Now that's the Shibuya crossing in Tokyo. And the first thing I need to tell you about Japan is that the yen is trading at a multi-decade low against the pound. Now I find that quite exciting, because I don't think as Brits we're used to having a strong currency relative to anyone in the world. But if you want to go to Japan, now is the time to do it, because it's cheaper now than it's been for decades. And just to show you how cheap the Japanese yen is at the moment, I'm bringing you the Big Mac Index. Now, the premise of the Big Mac Index is that a unit of something produced globally, in this case a Big Mac, anything that's produced globally should cost the same everywhere in the world. And if it doesn't, you can blame the local currency. So where a Big Mac is relatively cheap, we know that that currency is relatively weak. So does anybody know, I'm not going to ask you about Oldham prices, but if you went to London and you asked for a Big Mac, without the shake, without the fries, just a Big Mac on its own, anybody got any idea how much that would cost you? It's a bit like one of those questions that they ask, they try and catch out politicians and say, oh, how much is a pint of milk? Are you in touch with the regular person? I'll give you a book if somebody gets close. I have to say, $5.99 is a really good shout. Well done. 3 books and 1 table. I didn't have to walk there either. £5.79. A little bit cheaper than you thought. £5.79 for a Big Mac in London. In Tokyo, for exactly the same product, £2.28. 61% discount. And that tells you how cheap the yen is relative to the pound. Now, this is important as a UK investor, which I think most of you are, investing in sterling. It means that if you buy Japanese stocks and those stocks do nothing, but the yen returns to par value, you're going to do very, very well. But what sort of asset manager would I be if I suggested you buy stocks that aren't going to do anything? And that's where we have a stock story for you. So I'm going to bring you the stock story of Nintendo. Put your hand up if you've ever played a Nintendo game. Keep your hand up if you've played a Nintendo game in the last 12 months. F you and Brad. I don't know what's going on at ARK, but just you and Brad playing Mario Kart by the sounds of it. Put your hands up if you own shares in Nintendo. Most of you can put your hands up because it is in both the global equity portfolio and the global balance portfolio. And to give you the story of Nintendo, first I have to take you back in time to where Nintendo came from, which was Kyoto 1889. And they were just a very simple hand-painted playing cards business. All they produced. For 70 years, that is all they did. Hand-painted playing cards. Until the 60s, they kind of realized there wasn't much kind of a growth in the hand-painted kind of playing cards kind of arena, and they wanted to branch out and reinvent themselves. So they tried lots of different things. They tried becoming a taxi company. They tried inventing instant rice. They even went into love hotels, which are exactly what you think they are. Hotels rented by the hour, which apparently is quite a big thing in Japan. Who knew? None of that worked out, but eventually they landed on becoming a toy maker. And they became quite successful at making toys, and that eventually turned into, about the 80s, going into the 90s, they became very good at making games consoles. And that's what we know them as today, a games console business. But they own the rights to the Mario Brothers, to Zelda Warrior Princess, to Pokemon. I'm getting a lot of blank faces, but believe me, in popular culture, this is important stuff, right? So they've got all of those IPs. But if I could tell you the investment case for Nintendo in one sentence, it would be that Nintendo is turning a cyclical toy maker into a highly profitable recurring revenue platform. Because since the 80s, Nintendo basically has just gone around, and every decade or so it's created a new games console, and they've made a load of games for that console, and it either did really well, or maybe Sega did it better, and it didn't do so well, and it was really lumpy in terms of what they were doing. But now, there's three things that have changed quite significantly. Firstly, they're now digitizing all of their games. So instead of, when I was a kid, you used to get a little cartridge and put it into your Mega Drive or your SNES, they were still doing that up until a few years ago. If you had the Switch, you needed a little micro SIM kind of card that went in, that was your game. They now do everything online, which means people can spend their money at any time of the day or night, nag their parents on the first day of school holiday, all of that kind of stuff. So you can get that money in instantly. And it means you don't have to pay retailers, you don't have packaging costs, so it's much, much cheaper to sell the games as well. Secondly, you've now got a backdated catalogue of all of the games that they like to produce. So if you buy the brand new Switch now, the Switch 2, you don't just get the first 3 games that were produced because that's all it can. You can have anything that Nintendo's ever produced, you can have downloaded. And people like me love that because we love the 90s stuff. So we kind of go and download all the 90s stuff that we played when we were kids, and we play it with our kids as well. And all that makes them money as well. But the main thing that's changing with Nintendo, and bear in mind, this is a company that's has shown it's willing over the years to change itself, to reinvent itself, to make itself better. And at the moment, it's come to the realization that it owns a lot of intellectual property that's worth a lot of money. You know that Disney produced every offspin that they could possibly of Star Wars? Well, they've realized they could do that because they created a movie a couple of years ago called the Mario movie. I don't think many of you necessarily went out and watched it, but believe me, it was a massive phenomenon. It broke loads of box office records, and in Mexico, it was the highest grossing film of all time. And they don't even buy that many Nintendos in Mexico. And they've come to realize that they've got these characters that people love. And so they're now creating a Zelda Warrior Princess movie, and they've decided they're going to create a new movie every year. Movies drive the games, games drive the movies, and it creates a new generation of people that grow up with what they want to do. So Nintendo's turning from this cyclical toy maker into a highly profitable recurring revenue platform, but the market is still pricing it as a toy maker. Second stock for you. This time we're going to China, the Fujian province, and specifically the city of Xinjiang, because Xinjiang is affectionately known as Shoe City, because they manufacture 1 billion pairs of trainers. That's like 32 years worth of seconds, trainers, in 1 year. 1 billion pairs of trainers in 1 year. And they do it because the entire city is just a shoemaking exercise. Everything happens in the same boundaries of the city. You've got all the factories you need, you've got the skilled workers, you've got the cheap inputs, and you've got the finished box products. Everything is happening in one city. And traditionally, it's been Nike that's taken advantage of these economies of scale by having everything in one place. But more recently, the local giant Anta Sports has been coming up on the rails. Now, to give you an idea, about 10 years ago, Nike had about 25% of the Chinese shoe market. So about 25% of all the trainers that were bought in China were Nike. And at that time, Anta only had about 5% of the market share. Today, they're level pegging on 22% market share each. And if you're a fan of bad puns, then you could say that it's Anta that's doing all the running. You're not a fan of bad puns, fair enough, okay, I know your audience. So how have they done this? Well, they've done this by doing two things. Firstly, they've massively increased the quality of their product. Okay, so they're basically copied, if I'm absolutely honest, everything that Nike was doing, and they're using the same quality inputs and the same labor, and they're getting very, very good quality now. And you put an Anta sports shoe next to a Nike sports shoe, you wouldn't be able to tell the difference. So they've got a much better quality going on now, but they've also gone on a massive marketing push as well. And I don't know if there's any NBA fans in the room? No? Okay. Well, there are millions, hundreds of millions of NBA fans in China. So Anta Sports went out and they sponsored two of the game's biggest stars, Klay Thompson and Kyrie Irving, now play on the courts with their Anta Sports shoes on. So in Anta then you've got a very fast-growing business. It's got a really quality product. What about the price? Well, that's where this guy came in really useful last year. Because I know this time last year everyone was talking about tariffs. Here he is, the big man, with his baseball card of reciprocal tariffs, top of the tree, China, 67%. What did the world do? They dropped Chinese stocks like a stone, because obviously 67% tariffs is very bad for business. Anta Sports lost 26% of its value almost overnight. But if you were an analyst, and you were, well, an analyst at Orbis, let's be honest, if you were an analyst at Orbis and you were looking at Anta, you were rubbing your hands with glee, because you understood that Anta Sports was a Chinese manufacturer of trainers using Chinese inputs and Chinese labor to sell trainers to the Chinese market. What's that got to do with this guy? Absolutely nothing. We'll just buy more Anta Sports at a further 26% discount to its true value. Thank you very much. That was then, but even now, you look at the valuation, it's still miles cheaper than Nike. It's trading at a 55% discount to Nike, which is its closest kind of competitor. Its growth potential, well, its revenue growth is 3.5 times greater, and the margin, its operating margin, its profit margin is 2.5 times bigger as well. Last stock story for you. This time, anybody recognize this place? I'm impressed. Oh, you guys get around, don't you? Yes, the beautiful city of Copenhagen. And this is the home of the Euro's biotech industry. And the first thing I can tell you about the biotech industry, which is basically a byword for pharmaceutical, the first thing I can tell you about biotech is the whole industry is completely bombed out, as we would say. There was a flood of money into biotech, as you would probably expect around COVID time, and then once lockdown's finished, everyone fled that market and then some, probably going on to the AI train at that point. So the entire industry is really starved of capital and really struggling at the moment. The second thing I can tell you, though, about biotech is it's traditionally been a very, very good shock absorber in times of market volatility. And that's because it's completely different to anything else that's happening in the world. You probably would expect it to do well in COVID, but it did well in the GFC before that, global financial crisis, and the dot-com bubble as well. And that is because, I bet this isn't on your cheat sheet, it offers idiosyncratic risk. What that means is it's completely separate to everything else that's happening in the world. These companies live and die by whether their drugs get approved or not. Doesn't matter what's going on in AI, doesn't matter what's happening in China, they get their drugs approved, they're going to make a lot of money. If they don't get approved, they're going to get hurt. So it's completely different. But one company that's been able to bring its drugs to market is a company called Genmab. And without going into the specifics of how it all works, they've got a patented technology. It's called the DuoBody technology. And it's a bispecific antibody. And it's got this technology in it that grabs the cancerous cell and the body's immune system. It smashes them together to give the body the best chance of an effective response. But to give you an idea, only 4 such of these kind of antibodies have ever been approved by the FDA in the States. 4 of those 12 are owned by Genmab. And if you're an analyst looking at Genmab, you can put a pretty decent, accurate valuation on those drugs because you know how much they sell for, you know what the demand is, and crucially, you know when the patent expires because eventually the patent will expire and it means that the rest of the market can just copy that drug and they lose their competitive advantage. And if you do that with Genmab, you might say, okay, we think the current crop of drugs that they have in the market at the moment might be worth, say, $30 billion. And they've got a massive pipeline. So let's just say they won't all make it to the market, but let's just say a few of them do, and you put another conservative estimate of another $10 billion on that pipeline. You're basically valuing Genmab at about $40 billion. But Genmab today is valued by the market at about $17 billion. That means if you buy Genmab shares today, and this isn't advice obviously, but if you buy Genmab shares today, you're going to get them at a deep discount to their current book of drugs that's already in the market, and you're getting the R&D pipeline for free. And I said the entire industry's bombed out. When you find a diamond in the rough like that, there's often other companies that look very similar, doing similar things that are in a similar situation. Bringing all this to a close then, all of this is really important because if there's one thing history tells us, is it's the winners of one bubble tend not to be the winners of the next bubble. So very few of these names are repeated from one bubble to the next bubble. And that makes us very wary about extrapolating the current crop of winners too far into the future. Much better, we think, to do your homework, your fundamental research, understand the stocks, and find things that you think the market has misunderstood, put them all together in an uncorrelated portfolio. And just to bring you back to where we started, that's what the market looks like today. They're the holdings in the Global Equity Fund. So I'm not saying we have nothing in this bottom right-hand quadrant, but we've got our bets spread a little bit greater. And to leave you with one last image, I think markets look a little bit like this boat at the moment. The market environment, in this case the wind, is pushing that boat very significantly to one side. And we see, in terms of all that money being down in the one quadrant. But where's the skipper placing himself? He puts his weight on the other side of the boat to counterbalance what's happening in the market. And that's what Orbis does for your portfolio. We do something genuinely different to put weight on the other side of the portfolio to give you a diversification benefit. And that's why ARK have brought us in to do that job for your portfolios. With that, I will say goodbye. If there's any questions, I think I'm coming back on stage in a half an hour or so. So thank you very much for your time.
Give your microphone to James. Okay. Thank you very much, Ben. I'm now going to move the projector back to the 4x3 I asked you to. Just talk amongst yourselves. I hope you found that interesting.
Stay out.
Oh, there we go. And now we should be able to introduce to you James Clemster. Is that going to fit? He has got some slides, which I'm hoping I put. Oh,
You're going to get James.
there we go. Seamless transition, ladies and gentlemen. Rebecca has just snuck James outside because if you were here last year, you'll remember we played a game where the presenter last year, Keith, was going to say Donald Trump X number of times. Lorraine, are you listening? Because you got it wrong. I'm going to ask you all to write down how many times you think James is going to say or reference artificial intelligence. So if he says AI, artificial intelligence, anything, any of the AI bodies, how many times does he mention it? Might be once, might be 10 times, might be 50 times. I think 53 was the answer last time with Donald Trump. So write down how many you think it's going to be. The winner, the person who gets closest to it or the actual amount, wins a bottle of wine. All right? could you also, if there's 2 winners, could you also put a time that you think he's first going to say it? So this is what you got wrong last time, which is my fault for not explaining it. So everyone needs to write a number. How many times is James going to say AI or refer to it? Second is, when do we think he's first going to mention that word or reference AI? Everyone got it? The actual, into his, well, Anna's going to be doing the timing. Let's say into his speech. So what time into his speech? Because someone will have a different one. So is it 5 minutes into his speech? Is it 10 minutes into his speech? Blah, blah, blah. Anna's also been handing out some business cards of mine with my mobile number on it. If you've got any questions during James's presentation that you want to ask, just text me or WhatsApp me, and I'll make sure those questions come into the panel at the end, which is going to have James, Eddie, and Ben to answer the questions for you. Everyone happy with that? Any questions? You all excited? Fabulous.
Get him in.
Bring him in.
You're up.
Give him a round of applause as he walks in, 'cause it's quite a long walk. Welcome, James.
Thank you. Right, thank you, everybody. Not going to use the slides probably unless I get desperate.
Point on
Thank you very much. It's typical, isn't it? You wait for one generally different active manager and then 2 come at once. But no, I thought that was a great presentation, and it's really interesting to hear. I know Orbis well. It's a business I've known for a great many years, going back to my time when I worked in South Africa for my previous employer. So it's a brilliant business, very well run, and there's a lot of sort of chiming in terms of their process and ours. So looking at the world through a different lens is very, very important, and we'll spend some time digging into why in a moment. But I want to echo the point that Ben made at the start. This is that, yes, I can. This is actually pretty unusual to meet the end users of our solutions, and I think we should sort of reflect on how well ARK do to organise this, because very few firms do it, and it's funny when you think about it, really, because in most professional relationships, you meet the person doing the work, whether it be your financial advisor, whether it be your accountant, whether it be your solicitor if you're buying a house or sorting a trust out. And yet, for some reason, investment management, which is absolutely fundamental for your long-term wealth, you often don't get to meet the person who's actually running the money. But it's a firm commitment from us. We do it. We see the importance of it. It's very valuable for us as well to get feedback, understand what we're doing well, understand what we're not doing so well. So it's a standing commitment from us to do this as well. So hopefully, this is the second of many of these that we'll do. And as we go on, do welcome any feedback from any of you, any sort of questions. I know Brad said at the start, keep the questions to the end, but honestly, from my perspective, we're very happy to have the questions as we go, because it's meant to be a discussion. It's much more important to ask the question when it's fresh in your mind. It's like you're about to have an operation done. You don't want to wait your questions till the end. You want to jump in and say, hang on a minute, you just said that might hurt. How much is it going to hurt? So we might as well go through it as we go. So please do feel free to ask any questions as we go. Been asked by Brad to do an Outlook presentation, and again, Ben made a brilliant point, which is the J.K. Galbraith quote. There's another one, which is that forecasting is very difficult, especially about the future. There's one of those classic quotes where no one quite knows who said it. We are very mindful of the fact that in this game, it's very difficult to make any sort of meaningful predictions over the short term, because ultimately, sentiment, people's beliefs, can materially override valuation in the short run, but it tends not to in the long run. Think about any example of hubris in the last decades, really, but in terms of popular culture rather than investment management, whether it be, some crypto things, those NFTs, do you remember those, the non-fungible tokens, little digital monkey photos, and the most bizarre thing I've ever seen, frankly. Pokemon cards, things like that. These things have a moment where their value goes beyond any sort of recognition of reality. It's a bit of printed paper has no value whatsoever. Even money doesn't have any value. It's derived value through a promise to be paid by the government. So it doesn't have any fundamental value. It's fractions of a penny, and yet these things get sort of traded for a huge amount of money. You can go back to the 1600s, tulip mania in Holland. Extraordinary example of hubris, people getting really excited about something that has no fundamental value, paying an inordinate amount of money for it, until one day this sort of mania evaporates. It's like the emperor's new clothes. People look at it and go, hang on a minute, it has no substance to it whatsoever. Now, in investment management, most of the things we invest in have some substance. We're buying businesses, we can look at their cash flows, we can look at their assets, we can assume there is some value to that. And if we do it on a sort of aggregated basis, we've talked about stock markets already in this presentation, or indices, or tracking, as we often refer to, we're buying a collection of businesses in one place. They all have cash flow of some sort. Hopefully they're profitable. You have an idea of their liabilities, their outgoings, and all the rest of it. And if you do it on a sort of aggregated basis, the chances are you'll do all right. But from time to time, even then, you do get big deviations from reality. And you can argue, looking at the US today, that you have one of those there. AI is a phrase that we've all become very accustomed to today. I don't know if anyone's using it in their personal lives. We use it Liontrust a fair amount. We're sort of experimenting with it, really. We're sort of curious in terms of what we can do with it, but we don't commit to it wholeheartedly. We tinker with it, see what comes out, have a little play, and then go back to doing our normal work at the moment, frankly, because it hasn't quite got there yet. I'm sure it will, but when you look at the numbers that Ben put up, I mean, it's absolutely extraordinary. And the fascinating thing about AI in particular today is that a lot of those costs that you saw, this spend that's going into AI, is a similar business's revenue. So you've got this very risky sort of circular problem going on where one business has got a huge amount of money and they're investing in the stuff that's being sold by someone else over there, and it just feels a little bit imbalanced. It feels a little bit like we should be cautious. And so we, in the Liontrust multi-asset team, are. The good news, when I talk about sentiment again and moments of hubris, the antithesis is also very much true. You have pockets of overdone negativity. You've got areas where people sort of focus their chagrin and they get really sort of grumpy about it, and these things sell off and they become cheaper compared to their intrinsic value. And that's where active investment managers like ourselves want to be looking to take advantage and move things forward. When we think about outlook, and we'll sort of dig into what I mean by that in a moment, I always like to start by thinking, where are we? How did we get here? It's like when you get to the shops, one of these big sort of shopping mall things, and you say, right, I need to try and find John Lewis's or Clinton cards or whatever it is, and you go to that little map, and the little map's got a star on it. What's a star? It says, you are here. So we are here. Where are we, and why are we here? How do we get here, and does it matter? So let's think about where we are. We've had a period in the last sort of 10 or 15 years of quite profound change in terms of geopolitics, domestic politics, inflation, the cost of things going up, global growth. We've had tariffs. We've had wars in the European mainland for the first time in generations. We've had, trade wars. We've had all sorts of things going on, many of which we sort of almost presumed weren't going to be a feature of the landscape for the foreseeable future. There's been a profound change going on in the background. A lot of negative news. I don't know. I mean, we've already mentioned England versus France. I can't, putting that aside, there's not been that many positive news stories for years, frankly. You think about whatever it is, politically, domestically, geopolitically, around the world, in terms of global trade, in terms of inflation, none of these stories are positive. Does anyone fancy? I haven't got any books to give away. You've all got Lions. They're on eBay, by the way, for 20 quid a pop. if you fancy making a bit of money after the event. Anyone want to hazard a guess on, over the last 5 years to the end of June, what global stock markets have done? In broad brush terms. Sorry, how much? 70? 17? Good start, thank you. We can go up from that. Anybody? 30, that's bolder, I like it. Double it. Actually treble it nearly. 87%. All that bad news, all that negativity, 87% over 5 years. It's 60-something% over 3 years. They are better than average stock market returns. That's the bit of warning that it's worth sort of putting out there, because don't expect that year over year in perpetuity. That is high by historical standards. But I think it's worth bearing in mind that all that bad news out there, and yet the results globally have been pretty good. That's not just driven by the US. We've had good returns out of Europe, great returns out of Japan. We talked about Japan already. Decent returns out of emerging markets. The one laggard in all of this is the UK, which is quite interesting, because again, looking back at the previous slides, putting the US aside, third biggest stock market in the world, certainly developed stock market. We've got rule of law, we've got genuine democracy, loads of reasons to be positive here, and yet we sort of talk ourselves down, and the rest of the world have been doing it for a while too. But the way we look at it is actually the UK is one of the most attractive stock markets there are out there, because these businesses have sort of carried on ticking over, doing their thing, generating revenue, generating profit, but the rest of the world has kind of thought, wow, there's more glamorous things out there, we'll move on. We'll get excited about AI, we'll get excited about growth in emerging markets, we'll get excited about a new political direction in Japan. These are all sort of more glamorous, more sexy, and we're just sort of pottering along, being productive, being revenue generative, being profitable, but we're sort of unexciting, and we've fallen away from people's radars. For us, that's brilliant. That's a gift, because when the spotlight sort of moves away, that's the opposite of hubris. You get that sort of almost a vacuum of excitement. The price starts to drop, or at least underperform, and you find you have an opportunity for long-run investments to get in there, stick with it, and ride it through the tough times into the good times again. When we look at the UK as an example, we think it's a really, really very attractive stock market. We don't sort of dominate the portfolios with the UK, but we have more than most people do out there. So if the UK turns, you'll see us do pretty well, as it did, in fact, at the start of this year. It's had a bit of a weaker couple of months, but again, it's important to be differentiated, we believe, in investment markets, because you follow the herd, you're buying those big things, the really expensive stuff, you're buying the markets that have all the good news in the price already, and if the good news is in the price already, your chances of being disappointed are greater. We'd always want to be looking for opportunities that are unloved, unglamorous. It's a bit like, if you remember, in the old days, before the internet really, Boxing Day sales. Remember, people used to go and queue outside Harrods. They used to leave their family on Boxing Day, queue in the rain outside Harrods to rush on in. There'd always be a TV crew, wouldn't there? They'd rush on in there, and you'd be looking for a bargain. I can sort of imagine somebody flicking through, finding a pair of swimming trunks on a rainy day in December in London and thinking, well, those swimming trunks, they're deeply discounted, and in the summer, these are going to come good. And that's what we're trying to do. And we're looking around the world for investments for us in the multi-asset team at Liontrust to invest in. We're looking for those discounted swimming trunks, the things that are unloved, that are cheap. People can't realize their value. They have intrinsic value. They have a form. They have substance, but that substance is unappreciated at the time. So we get it. We take them home, put them in the cupboard, and at some point their value will be realized, and we get the benefit of them. You get the benefit of them through the portfolios. So bad news everywhere. Markets have done pretty well. What does that mean for outlook? Where are we going from here? I've mentioned already, inflation is higher than we've become accustomed to. That is, we believe, likely to persist. Not the really sort of high, scary inflation we got in 2022 as we came out of the COVID lockdown. On average, people were better off because they accumulated savings over that period. It didn't feel good at the time for lots of obvious reasons, humanitarian and, of course, news flow and everything else. But on average, because of what the government did to sort of keep us on an even keel, people came out of COVID with money in their pocket. Accumulated savings went up, There was not a lot to spend money on. It's not just a UK phenomenon, it was a global phenomenon. We all had money burning a hole in our pocket. We wanted to get out and do revenge spend. Do you remember that phrase? And people went out and they spent money, and you had an excess of capital looking for things to land on, and there was only a limited number of things to buy. It pushed prices up. And what it created was a sort of an expectation reset. And this is what's really fascinating, because inflation, like lots of other things, we talked about the Big Mac index earlier on, that's an example of inflation as well. Like many things, inflation is ultimately a reaction to expectations. If you think inflation is going to go up, on average, we will go to our employer and say, look, this year I need a bigger pay rise because my bills are going to go up and I need to at least sort of tread water vis-a-vis those. So you get this, inflation expectations get baked into an economy. Prices go up as a consequence of that, so it becomes a little bit sort of self-fulfilling. So what happened after COVID is we almost sort of remembered inflation was a thing. If you look back to the period between the financial crisis and COVID, that sort of period between 2008 and let's call it 2019, we'd sort of given up on inflation. Governments have given up on inflation. Central banks have pulled interest rates, which is their mechanism to try and keep inflation in check. They pulled them essentially down to zero in lots of the world, lots of the developed world. We had NIRP, negative interest rate policy. Remember that one? I'm not sure that's on your cards. That's sort of ancient history now. And ZIRP, zero interest rate policy. So we moved into an era where if you were a saver, you didn't really get very well rewarded on your cash. I'm sure lots of you experienced that. If you were a borrower, you were delighted because you basically didn't have to pay any money to borrow. That was not just consumers, not just mortgages. That was businesses and governments as well. And one of the reasons why we're tying ourselves in knots here in terms of the budget today, or not today literally, but the budgetary position of the UK at the moment, is not that we're borrowing greatly more than we were a couple of years ago, but the cost of that borrowing has gone up massively. So whereas perhaps in 2019, the government could issue a bond and have to pay interest of something like 0.5% or 50 basis points, that's in your sheet, a basis point, 0.5% interest on that debt. Today, for the same sort of debt, you'd have to pay 5%. So it's a massive increase. And so the problem is not just the volume of the debt, it's actually the cost of servicing the debt. So when you're looking around the world for opportunities, one of the things we need to think about is robustness of people's balance sheets, their ability, if they have debt, to repay it. That's not just a company issue, but it is important for companies, of course. It's also a government issue. We need to make sure we're looking for ones that can service that debt, that can manage it well. And the reason for that is because that's one of the asset classes we use in the portfolio. When you think about multi-asset investors, which we are at Liontrust, we combine the stock market, things like the FTSE, things like the S&P in the US, Nikkei or Topix in Japan, Euro stocks in Europe, and all the rest of it. We combine those with other asset classes. And the reason we do that is we want the best of both worlds in the portfolio. What I mean by that is ultimately the main way of generating wealth over the medium to long term is using the stock market. The stock market has been a very, very effective way of becoming wealthier in excess of inflation, as long as you're patient, as long as you're disciplined, as long as you hold on to it. The challenge with that is, again, on your sheet, the wiggly lines, and Brad's already talked about the wiggly lines at the start. The stock market lines are wigglier than most. They are volatile. They move up and down in pretty pronounced and profound ways. You may have seen, even this week, some of the sell-offs of the tech-related businesses have been absolutely massive. Luckily, it's been absorbed by good performance elsewhere. But stock markets, they're very rewarding, but they are volatile, to use the parlance that we use. There's a number of ways we can manage that volatility and mitigate it to an extent. The first one is by putting it next to other asset classes. So one of those I've already mentioned, which is debt issued by governments. Now, the debt issued by governments is fundamentally different from business profitability, which is the thing that really feeds into stock market returns. Governments borrow money. They generally have the ability to print their own currency, with the exception of a few. They control their own interest rates to a degree. They control their balance sheets. So they have a different sort of ability to repay than an equity, which is an investment in a company or an aggregation of companies. So you've got, on the one hand, the bits that's going to generate the returns, the stock market. On the other hand, you've got your bond exposure, your government debt, your company debt, which is there to do something different because it performs differently from the equity market. Your returns driver is the equity, and we use the bond markets as a means of diversifying the equity exposure because they do different things at different times. So you've got your returns driver, and then you've got your ballast, if you like, on the other side of the portfolio. So the other way we can manage risk and manage that experience really is by doing events like this, which is why we get so excited when we get offered the opportunity to come and meet and talk around markets and give you our views or talk about our philosophy to the end users of our solutions, which is that, ultimately, one of the things we need to do is demonstrate why over the long run, investing can be rewarding, even if it feels quite painful and quite sort of emotionally challenging over the short run. And what I'll do now is run to a little bit of data just to show you that. I won't worry about all of this. But look, let's go to here. So what moves stock markets in the short run is news, is change in sentiment. It could be, this is just obviously things chosen at random, but it could be, conflicts. It could be budgetary issues, all the rest of it. We don't know what that is. As Ben's already said, we can't predict these things. What we can do with some degree of certainty is say that, look, over the long run, and this is the stock market here, this is the UK stock market over the last 40 or so years, over the long run, stock market investing is a very rewarding thing to do, but it comes with wiggles, as you rightly know. One of the things we try and do at Liontrust, and I think one of the things we take very, very seriously indeed, is to remember that these wiggles often come in sort of quite concentrated bursts. Each one of these dots represents what the stock market did on a given day. And you can see, generally speaking, it's fairly well behaved. It sits in a relatively tight cluster between sort of plus and minus 2 or 3% a day. And generally speaking, it's narrower than that. But if you look over the periods of real stress, what we've got here is we're highlighting the 10 best days with the green circles and the 10 worst days in the last 40 years with these dots. And the key thing about it is two things. Firstly, generally speaking, and certainly you've got here financial crisis and COVID, generally speaking, what happens is you get the bad days first, markets sell off because sentiment suddenly changes and becomes negative. People tend to overreact negatively. And then after a period of reflection, people realize actually it's not as bad as I thought it was, and you get a sudden run up in markets going the other way. So you can see here, for example, around the financial crisis, a cluster of reds. They're amongst the 10 worst days in the last 40 years, and very soon afterwards you get a cluster of green. Same story when it comes to COVID, and in fact, some fascinating examples. You can't really read those so much, but you've got a number of bad days and worst days within the space of a month in the start of 2020. You've gone from having this real anxiety around a virus that no one really understood the impact of in sort of February 2020. And by, in fact, the day of lockdown in the UK was, I think, the second or third best day in the UK stock market in the last 40 years. Now, the important thing about that is I suspect none of us would have woken up that morning, turned on the news, heard about lockdown, and presumed it'd be a good day for stock markets. I think it's really, really very unlikely. So you may have felt the pain of these down days and decided, right, I'm done. I'm out of the markets. I'm going to sell. I'll take that on the chin, which is it's a choice. Obviously, it's up to an individual to decide whether that's what they want to do. But your chances of getting back in quickly enough to harness the market gains are very low because the markets turn before the news does. Happens every time. And let me give you an example of this mathematically. I'm going the wrong way. So this is the total return. If you had £10,000 and you put it in the UK stock market back in the the mid 80s, you have turned that £10,000 to £374,000. That's your total returns. There's not sort of got an inflation adjustment in there, but in nominal terms, you've done very, very well indeed, and indeed in inflation adjusted terms, of course, as well. If you miss the 10 best days, that same £10,000 only goes to 191. Still very good, but you've missed all of that potential upside because of that volatility, that wiggliness has put you off. You've sold at the wrong time, and you've missed the best days, which come very soon after the worst. And this is the example here. 24th of March 2020, second best day in the UK stock market in the last 40 years. It's up 8 and a bit percent. So it's just a sort of a reminder of the importance of patient, long-term, disciplined investing, because the markets, if history is any sort of guide, the markets will do it for you. You don't need to be too clever. You can, be patient, ride it through. If you've got anything more than, 5 years plus, history suggests you've got a decent chance of ending up with more than you started with, but there will be bumps on the way. You've got in your sheet says bear market, which is, a pretty significant market correction. Generally, when they're down about 20%, it's considered a bear market conventionally. They happen every handful of years, generally speaking. But before then, or more frequently, you get what's known as a correction. It's all euphemistic terms, of course. Bear market correction, which is where markets are down sort of 5 to 10%. You can expect those roughly every year. And most years you get something of that sort of order of magnitude. The point is that's not generally a time to panic. If anything, it's a time to look at your investments and say, right, okay, it's cheapened up. Is the world or is that stock market fundamentally 10% less valuable? Or has what's happened, is sentiment's overdone it, people have oversold, and over the long run, the opportunity remains there. And generally, again, if history is any sort of guide, remember this chart here, where is it? Remember that one there. If history is any sort of guide, when markets sell off, if you've got a reasonable time horizon for your investments, it gives them time to recuperate. Black Monday, 19th of October 1987, markets down 30% over a couple of days. That's that one there. So over time, the impact of these things diminished because of compound mathematics, because of businesses' ability to generate profit year over year on average and come out the other side. Now, clearly, in any environment, in any cycle, there'll be winners and losers. Some businesses fall by the wayside. That's obviously a bad outcome for investors. And that's why we want to invest on a diversified basis. We diversify between asset classes, this equity, the stock market on the one hand, government bonds on the other, which I've already sort of spoken about, but also geographically, you want to invest around the world. And even then, when you look at each different region, invest on a diversified basis there as well. So you might want dozens of stocks in each of these different regions. Let me give you a flavor for that, and then I'll probably pretty much wrap up. So when you're looking at our portfolios, look in the stock market part of that, our US exposure is about 30%, whereas in the global stock market, the US is, double that roughly. We have a lot less in the US than you would have if you just bought the stock market globally, because of the views we have of that. Our UK exposure is 16%, which is much higher than you would have if you just bought the global stock market. So, again, a different view coming through here. I won't run through all of these, but the point is you've got lots of different global exposures in the portfolio, just within the stock market piece, differentiated from most others out there, and with lots of diversification underneath. Hundreds of stocks in each of these regions. So you really aren't sort of overly reliant on any one company's fortunes. You get a global fortune come through, and even within that, regional exposures and all the rest of it, very different coming through in the portfolio. So in terms of outlook, I said at the start, we'll sort of come to the end and say it will be all right. Now, clearly, we can't guarantee that in the short term. We can't make any sort of guarantee around performance, and that's certainly not what we would ever want to leave you with, that sort of impression. But if history is any sort of a guide, the stock market is a very good way of generating wealth on average, as long as you have patience, discipline, and time on your side. If you have those things, then you have a reasonable expectation of achieving a profit over an investment time horizon from here, as you always have. So markets are, interestingly valued. We're concerned about the US. We like the UK. We like Japan, as it happens. We're concerned around Europe for various different reasons, but sort of valuation driven ultimately. We quite like emerging markets still. We're more concerned around Asia ex Japan. That's our sort of main selection of views in terms of our equity exposure, our stocks and shares exposure. We like government debt. I think it's actually sort of worthy of a neutral position in the portfolios because you get a decent yield and it does something different from the equity markets, the stocks and shares. We like bonds issued by companies. We call it corporate debt. We think that's an interesting area as well to differentiate the portfolios from the stock markets. So there's lots of different areas where we can, look to add value in the portfolios. But overall, ultimately, the main thing is discipline, staying invested, riding it through, because that's the best way to generate long-term returns rather than trying to chop and change and end up on the wrong side of those market moves. Those big moves are, not something you want to be on the wrong side of ultimately. I'll stop there, Brad, if that's okay.
Yeah, absolutely fine. Thank you very much.
Thank you. I probably should get to the...
Is this your compliance side?
I have to show this,
Yep.
I think. Yeah.
Everyone read exactly what's on the screen now, please. Okay. Cheers, James.
Thank you.
So I did tell James that I was going to track how many times he said the word, but he didn't know the word. The word was AI. Does anyone know the answer? Oh, we got 3. Oh, Zoe, did you make? Zoe, I feel like Anna, you're sacked. Right, so the answer was 4. We also, talk amongst yourselves. We got 4 minutes and 44.65 seconds. Excellent. We'll go with 4 minutes and 45 seconds. How many people got 4 as an answer? Put your hand up if you got more. If you got 4. 2 people, Chris and Alan. What time did you put? 3:45. Alan, you didn't put a time. Why do you? Did you put 4? Okay, no, Neil did not put 4. Last time it was about 50. Chris Gascoigne, congratulations, you've won a bottle of wine. Should we give a round of applause? Well done. Not yet, Anna. Not yet. Sorry. Okay. Before we do the panel debate, there's a 5-minute interlude with a bit of audience participation. All right. I should have made this table for you all, but I forgot. All right. So you're going to have to improvise. There's paper on the table. What I'm going to do is show you the investment performance of Columbia Threadneedle, Liontrust, and Orbis over each of the years. So I'm going to show you 2018, I'm going to show you 2019, 20, 21, 22, all the way through to 2025. And you have to guess, I'm going to show you the performance, but I'm not going to show you who's who. You have to guess who you think came first, second, and third in that year. Everyone with that? Yeah? Whoever gets the highest score, whoever guesses the most correct places, wins the other bottle of wine. All right? We all ready? Yeah? Paper needs to get around. You don't have to write the table out now. You can just, as we're going through, you can write down 2018, this, as we're going. Okay. Okay, I think everyone's got paper and a pen, hopefully. So, 2018, this is new to James because I've just thought of it now, but whilst the 3 fund managers are here, I'm going to ask one of them to give 3 words that summarises 2018. So, James, really throwing you at the deep end. 3 words to summarise what happened in 2018, considering whichever one you were, it doesn't look good. Fund manager performance of the 3 funds. So one of them is you, the other 2 are you. Pardon? Balance, DP5, yeah. More than 3 words. There you go. There you go. Thank you very much. Okay, so you should all now have on your paper 2018 and in an order, okay? 2019, same thing again. Ben Moxon, would you mind giving us 3 words to better year? Everyone was up. Feb pivot year. Okay, there you go. Make of that what you will. I'll leave it on there a little bit longer. You've got to guess a first, a second, and a third. Third was pretty bad. First and second are right next to each other, pinning it all the way. And your options are, to reiterate, Columbia Threadneedle, Orbis, and Liontrust. They're your 3 answers. Okay? Moving on to 2020. Which of the fund managers wants to answer this one? It's probably the easiest one you're going to get. James. Go on, Eddie. Anyone? Nice, thank you very much. Okay, so everyone did badly until you all just about made it above that green line by the end of the year. But who made the best and who made the worst performance? Okay, moving on to 2021. Fun fact about 2021, at some point through the year, every fund manager was the best. So right at the beginning, the red line was the best, then the blue line was obviously the best, and there was a period where the green line was the best. So you can see that they're moving in different directions at different times. It's not about having just one fund manager. Hey, what's this one? Reopening boom, yeah? Reopening with a hyphen, yeah, I'll take it. There you go. Thanks, Phil. Okay, 2022. This was a very, very good year for someone, and Eddie's asked for it. So maybe, maybe that gives you an idea. Eddie from Columbia Threadneedle. Four words. Okay. So again, 2022, you need Columbia Threadneedle, Liontrust, and Orbis, or whatever order you want. You've got to guess who does best. 2023, really, really close year at the end of it, but more going on inside. James? These people have got their ears to the ground, ladies and gentlemen. Every day they check. I am conscious, by the way. I invented this a couple of days ago, and James did not know about this at all until he just came off the stage then. So I am quite literally putting him on the spot. 2024. The colours don't mean anything, by the way. I kept changing the green, the blue, and the red. So don't think you can. Yeah, don't think you can decode it that way. I saw you all coming there. Yeah. Well, sorry. Keep showing your toes. Ben? Yeah. It was a good year for everyone. Nice. That's a good one. Probably doesn't mean anything. I get that. That's cool fund manager talk. 2025, this is our penultimate year. In fact, no, this is our last year, sorry. We're not doing a 2026 because we're only halfway through. Someone has done exceptionally well against the other two there. Okay. Everyone got an answer for every single one? Yeah? Sorry about the colours. I should have said that earlier. My mistake. Okay. The results, bear in mind, you should have now 2018, 19, 20, 21, 22, 23, 24, and 25 as tables, and then one of the fund managers placed on each. So I started badly. I'm sorry to embarrass you all. Columbia Threadneedle did the best, only losing you 0.7%. All right. Orbis did quite a lot worse than that. I'm sorry, Ben. Minus 7.5. All right. Anyone want to guess the next one? Shout out. Who do you think's top in the next year? Shout out. Columbia eventually. You got Columbia again. So the same performance in terms of who came first, second, and third, but very, very different returns. Orbis, well done. You didn't lose us any money this year. You made us 9.1, and that was the worst performing one because Liontrust did 17.4, and Columbia Threadneedle did 15% pipping Liontrust to the post. 2020, everyone's favourite year. Unbelievably, considering we had the COVID pandemic, every single fund was up in that 2020 year. Sorry, Ben. It does get better for Ben. 2021, everyone did even better. I should be getting a guess. Do you want to guess the next one? 2022? Shout out. Who do you think came first? Considering pretty like linear at this point. Who thinks? Well, guess. Shout out your guesses. Oh, Orbis first. See, there you go. Redeeming yourself. In actual fact, this is a big redemption as well, because whilst Orbis have been not doing so well, 2022 is the year where two of them were massively down. Orbis are doing 20% better than Liontrust. Sorry, James. Absolutely. Want to guess the next one? Liontrust. Orbis again. All right. Everyone's up that year. Pretty close year in all fairness. Only 1% between them. 2024. Orbis again. Now, do you like this game, Ben? Yep. Thought you might. Final year, 2025. Orbis again. So what a juxtaposition of movements around. You might... Now, I looked at this and thought, I can't show this because James, first of all, he's bigger than me, and I know he goes to the gym, and I don't want to fight him because he doesn't come top at any point. I thought, how can I embarrass James like this? In actual fact, when you look at the data, in the year, Liontrust lost the least peak to trough, which you might think, well, that doesn't matter. It's all about a year-on-year performance. It doesn't. In the cheat sheet, it talks about drawdown risk, which is when markets are down, the more you lose, and the more you're then taking out in regular income, puts the handbrake when you're recovering. So actually, John Husselby, your friend and boss, says this a lot. Sometimes you can win by not losing, and that's exactly what Liontrust do. Okay, so whilst they're not top every year, they tick along, middle of the road most of the time. That's exactly what you want. We should really, arguably, have just Liontrust. But look what happens if you add more in there. This is why we have more than one fund manager. Okay? Scores on the doors. I've not even totted up what the maximum score is. I think it's 21, is it? Is it 24? Oh, yeah, there's 8. Yeah, thanks. Okay, so Max, has anyone got 24? Excellent. So you can't get 23, so it must be 22 is next. 21, 20, 19, 18, 17, 16. You're all due your annual reviews by this point, by the way, and you weren't paying enough attention. 15, 14, Neil. 14 as well, John. Oh, sorry, John. 14 for Neil. Well done, Neil. Okay. We'll grab the chairs. Now time for the discussion between the three of them. So ideally now, they can fight it out and Eddie can tell us all why they did so terribly and Ben can tell us all why he did so terribly years ago. I'm going to just do that, yeah. I'm stealing that, sorry. Okay. You've got a microphone to pass between yourselves, I believe. Fabulous. Okay, so first of all, my phone has not stopped vibrating with questions. Sorry, no, literally no one sent me a text.
I was going to send you one as a joke.
Oh, thanks, Eddie. I wouldn't have replied. Right. Before I've got some preloaded questions because I expected that no one would text me. Thanks. Does anyone have a question they want to start with? Kath. Yep.
Well, I've got the.
Just near your chest is fine.
Oh, just in my chest. Okay. I've got the microphone, so I'll start. If my compliance department are watching this recording, I'm not an advisor. I'll just have to make that very clear to start with. I think so. Almost every answer I'm going to give is about how we view the world from a bottom-up perspective. And so, because we don't do the macro, we look at how this kind of impacts the stuff that we're interested in and that we like to buy. I think the problem with trying to predict what Donald Trump is going to do is just impossible because he's inherently unpredictable, right? Goodness knows what's going on with the Straits of Hormuz. It's open, it's closed, it's open, it's closed, it's open, it's closed. The longer it stays closed, the more damage this is going to do to the world economy. It's going to take months to get back to normal. Already, even if it was ended today, it would probably take at least a year for everything to kind of get unwound. From our perspective, thankfully, most of the stuff, we do have some energy exposure in our portfolios, but the energy exposure we have is not really the oil kind of side of things. We were hit in the first quarter of this year because we've got a fair amount of money in the microchips for the AI in terms of the manufacturers. So not necessarily the NVIDIAs of the world, but more like the Samsungs, the SK Hynix. They're all in South Korea, and South Korea gets a disproportionate amount of its energy through the Straits of Hormuz. So that was a big hit. The good news is that actually the cost of energy going into chip production is actually very, very low in compared to everything else. So whilst the market was hit, it wasn't really very fair. So yeah, we look at it from a bottom-up perspective. We haven't actually made any changes to our portfolio on the back of the Straits of Hormuz at the moment because you can't predict it. You take the short-term hit if it comes, but everything that we lost in Q1 was kind of made back again in Q2. So it's really difficult one for us to predict that. I don't know if anybody else wants to take that on.
Could I? Yeah. Well, thank you for the question. And it was actually Keith from Columbia Threadneedle that was tasked with the.
Louder.
Oh, sorry. Speak a bit louder. I'm always told I'm too loud at home. Now I've got to be louder here. No, so it was Keith Balmer from Columbia Threadneedle that had the task of how many times he said Donald Trump last year. And actually, when we think Donald was one of the phrases that Keith uses. Actually, you should take Donald Trump seriously, but you shouldn't take him literally. I don't know if everyone remembers him saying that. And actually, when we're looking at the Strait of Hormuz and we're looking at the actions that have been taken at the moment, what we're finding is markets are actually moving more on what the Iranians say than what Donald Trump says, because Donald just says, yeah, they want to make a deal, and actually what we're seeing is markets and oil prices moving more in and around, is the fighting recommencing? Have those shipping lanes, stopped the small amount that was coming through? To reiterate what Ben says, the longer this goes on, the worse it is for inflation and the worse it is for markets. But hand over to the fund manager on stage to give us a more detailed answer as well.
Yeah, I mean, it's a fascinating one. I've done lots of videos and bits and pieces on it, which we'd happily share if you're interested. I mean, I think at one level, we argued before it all sort of became, well, when it was starting, we argued that you catastrophize about these things. There were people suggesting it was going to go to $200 a barrel. There was others saying it was going to be done in a matter of days, and we were of the view that generally the most likely outcome was somewhere in the middle. Don't ever underestimate human race's ability to muddle through and compromise and make stuff work. And I think, to try and sort of provide a different perspective, I think it's extraordinary that oil is only $100 a barrel, really, given, you've lost, 20% of the world's supply, in theory. So either it's coming somewhere else or being sourced another way, or we're using it less, or, but it's extraordinary that it's not higher, I think. I'd also, echo Eddie's point that I think the president's ability to move markets is perhaps less impactful now than it was. You almost got sort of diminishing impact of that, the boy that cried wolf, I guess, in a way. And then a final point, which, again, if I take you back to the slides we showed of the FTSE over 40 years, all these sorts of events create noise, they impact sentiment, they will have inflationary impacts. They will impact, growth in the short run, but over the long run, businesses adapt. They're incredibly adept at changing how they operate. We adapt, governments adapt, economies adapt, and people move on. And there's been plenty of shocks in that long-term chart, plenty of very, very horrendous, genuine global experiences over that period. But if history is any sort of guide, there'll be a way through it.
Thank you, James. Any other burning questions before I fire something of my own? Fabulous. That's my question. Go on. You ask it better than me anyway. You always do.
AI and its impact on the economy. We've heard a lot of caution about worry about AI and the good that it can do.
So,
Not just your homework.
no. So I think when we're looking to businesses now, the implementation of AI is actually what we're finding is it's helping businesses become more efficient and be able to run more smoothly and get to the end result that they need to get to more quickly. But what I think we must be cognizant of is it is not something that is going to fully replace some of those roles that are required, where we require that human level of input. And when I look into my industry, sort of specifically sort of my role, I have quite good use of AI. It helps me in my job, but it's never going to replace sort of me coming to see Bradley and other advisors and helping them understand the way markets are moving, because it is just feeding back to us. AI is ultimately feeding back to us what already exists, the information that already exists that's out there. So I think I think about mobile phone technology being a really good example of this. So when we all got a mobile phone, I used to play Snake and text my mates. I didn't envisage that one day I'd be able to book my train tickets, my holiday, trade, securities on there. But these things evolve and they grow arms and legs. And I think we are at the beginning of that journey. And I think it's got a lot of good to do. But I think sometimes we need, like looking at the stock examples, as humans, we do get slightly over exuberant about these things, and there will obviously be winners and losers in that. Sorry. I've only got short arms.
Long pockets as well. Just to build on what Eddie says there. I think that most of everyone's scratching the surface at the moment, and I think the full potential probably won't be seen for a few years. You hear about people talking about these AI agents, and these are things that you'll actually send off to do actual jobs for you. So rather than just it becoming a bit of a posh Google, you can actually say, instead of saying, actually, I've found this hotel in Turkey that I might want to go to, is it good? Instead of it asking that, you can just say, I want to take off 7 days. I don't want to go anywhere less than 20 degrees in October. I want 5-star and my budget is £3,000. Go and book me a hotel. Don't just find stuff for me. Go and find me the best deal you can on the best hotel that you can. And I think that's the kind of thing where it will actually start changing our worlds when it's more than just a search engine. But the only other cautionary kind of tale I would throw in there is people say that AI won't replace jobs. It'll just make you better at the job that you do. And that's fair enough. But if we all become better at the jobs that we do, you're going to need fewer people to do those jobs. And I think that people talk a lot about the productivity gains to be had, but the only kind of offside to that is that if there's productivity gains and there's then commensurate kind of layoffs, then you could see unemployment going up, and unemployment then becomes a burden on the state as well. And how do they pay for that? It's got to be increased taxes on the people that are paying into the system. So it's yet to be seen how all of this is going to kind of unravel in the system, but there's pluses and potential minuses as well.
Final little bit, if I may. I think the other point from an investment standpoint, we talked about the dot-com bubble a little bit. It's worth remembering, if you cast your mind back 25 years or so ago, the big thing we got wrong, coming back to Eddie playing Snake and sending text messages, the thing we got really wrong during the dot-com bubble was we grotesquely underestimated the impact of the internet, and yet there was a 25-year period where a lot of people lost a lot of money that was only just been made back in some instances in the last year or so. So, a good business or a good investment thesis or business thesis at the wrong price is a terrible investment. And so the real thing to be careful with is not the particular pros and cons of AI per se. We're probably massively underestimating its impact over the next 25 years. But the main thing is, look at the amount of money that's being spent on it. Is that going to be productive, or is it going to be competed away? Are cheap entrants and emulators and everybody going to steal these guys' lunch? And that's a very different point from the societal AI-related use case. An investment case is one I think you need to tread carefully.
Thank you, James. Kath, you got another question? Well, sorry, before you do, James, you got the mic. You have a good answer for this. I know you do.
Do I?
AI fluff. We talked about
Oh
this.
yeah. We talked.
We've
moved on from that a little bit now. I mean, I think the quality output has improved a lot, but there is an inordinate amount of nonsense produced by it. I think Eddie's point is a very good one. I think what it can do quite effectively is reflect what's already known in a sort of nice, neat, summarized way. But what it doesn't, and I think the AI people would be the first to admit this, is genuinely no innovation in it. The algorithms are essentially, looking probabilistically what word would best follow the previous one in an answer, and that's how it strings together a large language model. It's extraordinary. It's absolutely amazing. When you get it to draw stuff, it's amazing. But there's so much fluff and nonsense in there, and that will long continue, I suspect. But take it carefully and don't stake your career on it. Don't use it for tax advice. Don't use it for financial advice. Don't use it for investment advice. Anything where it actually matters. Don't get it to write your will. But as a curiosity and as an efficiency tool, I think it's great.
Yeah. Yeah. Question from Dave. Zoe, are you still keeping the count of how many times we said AI?
Yeah, exactly.
James has given me the microphone, so I guess I'll take that one first. Hopefully that came across in my presentation. We're not saying ignore it completely. It's going to be part of your portfolio. You can't get away from the AI theme, but generally, just have something completely AI agnostic. Completely different. I gave the example of a GenMab. It doesn't matter what's going on in the world economy. I've heard one of the fund managers have a joke and say we're now invested in Greggs. It's not a massive position, but we're investing in Greggs, and I don't think AI is going to replicate a sausage roll. So there's plenty of things that you can do to insulate from it. I guess my main concern is if there is going to be a market correction because people understand that a lot of money was spent and then a lot of money was wasted. that suddenly at some point there could easily be some sort of market correction. And I'm not here to tell you that that's going to happen, but it'll be remiss of me to not leave that open as a possibility. And when that happens, everything gets sold off, right? It's not just your AI stocks. Everything will get affected at some point, at some level. The question is, how deep will it be, and how sharp will it be, and the recovery as well. And the only thing I can say is, if you lose focus and you lose your nerve and you sell at the bottom of the market, then you're selling a loss. But as we saw in COVID, we thought the world had ended when COVID was happening. And again, one of the asset managers that I speak to said it was a really useful exercise because we got to know what ground zero is. Because the world economy shut overnight, and nobody needed any oil, nobody needed energy, nothing was being produced. So much money was being put into the system, and we got to understand where the worst case scenario is. And actually, that was the best time. One of the reasons we did so well in 2022 is because we were buying Shell and BP at that point, because the world was acting as if we don't need oil majors and gas going forwards. That's how things were priced. And we were picking those kind of stocks up at ridiculously cheap values at that point, knowing the world wasn't ending, because if it was, we've got bigger problems to deal with. And that's one of the reasons why we rebounded so well in 2022, because we were picking up those kind of things that were just ridiculously cheap, that we knew had a big role to play going forward. So yes, it's a bit frightening. There could be a market sell-off, but hold your nerve, because everybody on this panel has people, very intelligent people, that are looking at best ways of managing that, and making sure you get the best of it going forward.
Yeah, one thing just to add on that, Brad, I think the other thing is that, equity markets, stock markets will likely be impacted by that scale of the sell-off, because it will be absolutely gigantic, obviously, if they really had a bad time. But, you can have less in the US than being market capitalization weighted. That will likely help. You can have less in these names because you have managers that are diversified. That's kind of the point that Ben was making. And the other point, the final point I think is really worth making, is that you can have global government bonds, you can have cash, you can have other assets, alternatives, gold. It's not a given that everything gets hit the same amount, which is the point I was trying to make in my presentation, that, it's worth having other stuff around the stock market, because as great as it is as a means of rewarding over the long run, it is wiggly, and that would be a big wiggle.
Yeah, just to really back up both of the points there, I think the exercise that Bradley did there, looking at us three managers and how we performed in different economic environments, is really how that protection comes in. There might be a manager on stage that is overweight to a particular area and underweight, and that will change going forward. And the skill that Bradley has then putting us together is to make sure that we're not drifting from what we say we're doing, and we are running money in the way that we say we do, so that actually there will be times when, unfortunately, James and I are not giving you the returns, but it's okay, because Ben's going to come in and prop up with the returns that we saw in 2022. So I think having a blend of managers is a massive way that you mitigate that risk.
Thank you, Eddie. Any other questions? Yeah, Paul?
What might be the impact of
Good question.
Give that to the economist in the room.
For the points of doubt, I'm not an economist. No, I'm not going to be rude about economists. It's a fascinating one. Don't we already have digital currencies? In the sense of
store of value, I suppose.
No, but I mean,
as a recognised currency that would be used by a central bank other than.
I'm making a slightly glib point, but I think.
Digital currency at the exclusion of cash.
Again, I think we're pretty close to that. I mean, the number of cash transactions are through the floor. They're almost non-existent in some economies now. But I know exactly what your point is. But I think I would make a general point, which is that the scale of, cash-based transactions is actually, fallen off a cliff in the last sort of 10, 15 years. I think there's if you get into the land of crypto, people get very excited about blockchain technology, and it's apparently sort of unhackable and a permanent record, and all the rest of it. But you know, ultimately, what is the purpose of a currency from a government's perspective? It's, you know, it's a means of exchanging wealth. It's something they want to be able to regulate and monitor and tax and all the rest of it. And, you know, if a digital currency is going to be mainstream, it has to sort of conform to certain norms which allow governments to really sort of be in control of it, surely. So I don't know. I'm interested to hear anyone else's view. We don't think of crypto to be specific as an investable asset. It's an interesting speculation, and you know, we've used the example over the years of you know, it's like going to the races with your granddad. You know, you've got your money that you don't mind losing, and that's the one to have a little flutter. And then you've got your get home money, which you don't put on it. So if you've got a bit and you want to play on the side, then it's not a bad idea. But from our perspective, it's not investable. It has no fundamental value. Going back to that previous point, you know, what's its value? It's just derived from, you know, someone else being willing to pay more for it. And these things have value until they don't. At least we know when we're looking at businesses, when we're looking at government bonds, all these different sort of fundamentally, you know, substantial in a literal sense businesses. They may go up and down in price. They may go, you know, through periods of profound underperformance. But if you look at a business, you can see their assets, you can see their liabilities, you can see the cash flow, you can see why it has value. Something like a digital currency, even, you know, sovereign currencies go through spasms of massive volatility because people's faith in them goes up and down. And these are things that have got government backing. I mean, they're serious entities. You know, a digital currency without a government backing behind it, without any sort of physical, you know, sense of a collateral, has value until it doesn't, ultimately.
Thanks, James. Next.
Yeah, I mean, we would totally agree with Columbia Threadneedle. No, we wouldn't look at crypto as something that we would have as an asset class that we would involve in the. Yeah, I know. Yeah, just to. Yeah, I know it was more about digital currency, but just to reiterate James's point there, we wouldn't.
Yeah. Oh yeah, Ben.
Just, I guess to the point I think you were trying to make, that everyone's being forced to make digital transactions by card or by phone. I mean, I know this frightens the life out of some people. My parents don't have contactless, you know, so like they certainly don't have Apple Pay, and they've got no intention of ever being able to tap a card. They prefer the chip and pin because they know someone can't just be on the bus and just kind of walk past them and kind of take 30 quid. I think there's just an awful lot of kind of just blind goodwill in the system that the bank will sort us out if someone kind of does manage to steal a little bit of money from us. I think it's very sad. I think it gives the government a little bit more insight into your spending habits and into the money that's going in and out of your account, which helps them deliver, you know, the tax a little bit easier as well. So, you know, the cynical part of me might say they want to phase it out because it gives them a little bit more control. It's just a bit of a shame. I mean, like you go to some places and you offer them £20 for something, and they're like, "Oh no, we can't take that." And I'm like, "Well, my phone's out of battery, so it's that or nothing. I'm not having anything then." So I think it's sad, but it seems to have really gone on a pace this last few years, and I don't see it kind of reversing.
There's no hands going up. I presume that means no questions. Can I finally ask Michael? Oh, that was. Yeah. I'll get my question out at one point. Dave.
From our perspective, 100% not. No. We don't even make investment decisions by committee because, as I say, we're contrarian. If you're going to take a different opinion to the market, you don't reach a consensus view by having 6 or 8 of you around a table and agreeing to something. So we empower our individual portfolio managers to make those decisions. As the point's already been made by Eddie, the AI is just everything that's ever been written, kind of homogenize into one thing and you get the average kind of that coming out of it. I don't think I've ever heard of anybody that thinks that letting AI make investment decisions is a good idea. I personally would shy away from it if I heard of that kind of thing, but absolutely not. For us as an active manager, it is a human decision and it will always be a human decision.
There was a fund run by one of your South African compatriots quite a few years ago.
Yorkshire, so I don't know.
No, yeah, your parent company, South African, which did it a long time ago. I don't know what happened to it, but yeah, look, it's a great question. We use it as a means of doing exactly the point that Ben just made, which is trying to understand what's already universally known, what's already in the price, what's kind of sat behind all the money that's flowing around the world, and what's in those valuations. So, what we will ask, and I do this on a quarterly basis, I ask 3 or 4 different AI models, what's your view on the next 12 to 18 months on this stock market, that stock market, those government bonds? Not because I want to know what it thinks, but I think it's a really good way of knowing what everyone else thinks. And coming back maybe to Ben's point about being a bit contrarian, at least understanding what's in the price, finding an opportunity to exploit that. And so the more information I can get across my desk that gives me a view of what other people think, the more I can decide whether that then offers an opportunity for me to exploit on your behalf, essentially.
The same as James and Ben there. We don't use any AI tools in the decision-making process, in the information gathering and sense-checking process, maybe so. And I think I have seen some YouTube clips of sort of guys that are saying, join my AI algorithm trading 2-on-2 account type thing. And what you're going to get from those is you are just going to get the momentum. So what is doing well, it'll want you to buy more of that. That's the way that these things would typically offer advice. And clearly that would work for a certain period of time until that momentum was no longer in the market. So I think there's risk in those sort of tools. But you'd be hard stretched, I think, to find a manager that says that they use AI to make decisions.
Fair enough. Next question. Phil's saying wrap it up. I've not asked a question and I really want to ask a question. So I'm sorry everyone, you've got to sit here. Last question. You're probably all going to come back next year, so I can write this down, remember the answer, and then hold it against you. Investment markets.
To be Keith. Fine.
Investment markets are constantly trying to look around the corner. The reason AI is doing so well now is because of what we think AI is going to do in terms of valuation, is because of what we think AI is going to do in the future. What's going to happen in the next 12 months? So I can hold you to it next year, and you'll all be back, and these will all be back too. Is it going to be space exploration becomes the next AI? Is AI going to fall over? Is there more to go? What do you expect, now you're close to the mast, to happen in the next 12 months? Sorry to put you on the spot. You're all looking very frightened. I'm not going to really hold you to it, but
You mean specifically in terms of AI?
No, more broadly than AI. I think space exploration. I think Elon Musk is going to set a new precedent.
Within 12 months?
I don't know. Why not?
Well, I mean, actually, I've read a book about the original moon landings, and the thing that blew my mind was how quick it all happened. You go from between Apollo 8, which was I think the first one where they actually pinged around the moon and came back, having only started doing Apollo missions a couple of years before, and then within a year or so from that, you've got Apollo 11 land on the moon in 1969. So, that was an extraordinarily quick change. Bear in mind, when was the first flight?
1912.
Yeah, and then only 200 years before that, what's his face was heading off to discover Australia. So, we can collectively do amazing things in very short order. So, the sky's the limit in that sense, and I think we should all be pretty optimistic about prospects of humanity over the medium to long term. But I'm afraid, predicting over 1 year is a mug's game, ultimately.
I should have paid more attention to Ben's presentation. Okay, right. Phil's still going to be telling me to wrap up, so we'll wrap up there. Thank you ever so much for coming, and also thank you all ever so much for coming as well. You made the day. Thank you. Been promised, the bar is open, so you're more than welcome to stay for a drink, courtesy of Phil's wallet.